folks that do not make it onto the call, we certainly will be able to, and we'll send it out. You can share this with friends and neighbors as well if you need to. So feel free to do that wherever. We will have myself starting us off. We'll also have Eric Boyce, our CEO, who will tell us, just give us an introduction, and you can see Eric there on the screen. And then we'll let Eric Olson from First Trust kick everything off and introduce Bryce Gill, who's our panelist. A couple things down on the bottom of your screen. If you're having any kind of problem seeing, or you won't necessarily be able to speak on here, all the controls are on the bottom. You can ask questions through the Q&A, which I think Anya looks like she found. So in the Q&A, feel free to ask questions. I'll be moderating it. As questions come up, I will then share them with the panelists. We also have a chat functionality, so if you've got any questions or problems throughout the process, just feel free to shoot that out, and I will be more than glad to answer, get that in front of you. So I will kick us off right now and kick us off to Mr. Boyce, who will talk to us a little bit about what the call's about today.
Great. Thanks a lot, Jeff. Appreciate it. And I want to say thanks to everybody on the line today for taking time out of your day. I know even though we're socially isolating, we're still busy in our own regard. So appreciate you taking the time. And I think part of the scheduling was wanting to leave some time afterwards if there was an interest in having follow-up conversations. Really kind of the context of the visit today is going to center on the economic backdrop. And so we have a tenured economist with First Trust, who's a terrific partner of ours on the investment side, that's going to be here to talk to you, to kind of give his thoughts on the economic backdrop. And obviously we spend a lot of time deliberating over the investment side. And I just want to hazard that sometimes the economy moves in the same direction as the investment market. Sometimes it doesn't, but there are two different things that just happen to be interrelated. And as we sit here in this unprecedented time, in this unprecedented set of circumstances, with market gyrations, the likes of which we haven't seen in some respects since the Great Depression. In fact, just today we recorded the end of the shortest bear market in history today, with a 6% plus move in both the S&P 500 and the Dow Jones Industrial Index. And what that means is that we're already 20% off of our lows. But I want to caution, and I think you're going to hear this in some of the comments from our speaker today, that there's some known unknowns. There's some things that we think are going to happen, but we're not exactly sure how it's going to channel into the into the real economy and into people's back pockets and so on and so forth. So we would expect more volatility. Before I hand it over to Eric Olson, I want to, we've got several of our folks on the line. I'll just mention them. They're in mute mode, but Tom Kimler, Lindsay Sharp, Carl Van Roosen, and Jonathan McQuaid are financial professionals that are on the phone, along with Jeff, who you just heard from, and myself. And just a brief word before I turn it over to Eric Olson. First Trust is based in Chicago. I'll let Eric kind of give you the brief background on First Trust itself. But I just want to tell you, from my perspective as a chief investment officer for BKA, that we've worked very closely with First Trust on a lot of different things. They bring a lot of intellectual capital to the table, and they really help us do what we do. And we pride ourselves on our independent thought, our independent research, our independent thinking, but providing the inputs and the data to help us make those decisions is very important. And First Trust is a fantastic partner in that regard. So With that, I would like to now turn over the call to Eric Holson, who's in institutional business development for First Trust, and a friend of mine, a friend of ours, and he can introduce our speaker, Bryce Gill. Eric, I'll turn it over to you.
Awesome. Thank you, Eric. Thank you, Jeff. Yeah, we're going through a very interesting time in history, and as you all know, it's kind of unprecedented what has happened over the past couple of weeks, and we can't reiterate enough how much First Trust believes in the financial advisor. And I will tell you, from traveling amongst 5 different states across Texas, Louisiana, Oklahoma, Arkansas, BKA Wealth is one of the most established, one of the most polished, and ultimately just really good guys to work with. So for all of you on the line that have trusted BKA, and for some of you on the line that have trusted First Trust, we thank you. So as we're dialing in right now, I know Bryce is on the line. And before I introduce Bryce, I did want to say a couple of things about First Trust. So we are the largest active ETF sponsor. We're one of the fastest growing ETF sponsors, and we've recently been awarded the most shared and the most read research out there. So Bryce is on our economics team, and right now there's over 20,000 financial advisors that follow our econ team. And maybe even Bryce can touch a little bit on that. But Eric, Jeff, appreciate you guys having us, appreciate the partnership. And with that, I'll hand it over to Bryce.
All right, well, thanks, Eric. This is Bryce Gill. I'm an economist here at First Trust. We're having a little bit of technical difficulty on my end, so I'm calling in, and I think Eric is going to have my presentation open and kind of take us through the slides. So, Eric, do we have that first one up there right now?
Yeah,
I'm trying to get it up right now. Hang on one second.
Okay.
I see it on my share.
Oh, you do?
Okay.
Yeah.
So, and that's the one with all the econ team on it. Yes.
Right.
Okay, great. So, just to introduce myself before we get started here, you can see me down there on the bottom right-hand corner. But First Trust Economics team, there's 5 of us. Bob Carey, he's on there. He's our chief market strategist, so he's more in tune with the equity markets, while the other 5 of us are more focused on the macroeconomic side of things, kind of the view from 50,000 feet, if you will. So, recently, before all this craziness, blew up and surprised everybody, we were awarded the number 6 economics team in 2019. So we're really proud of that. But, I think the thing we're more proud of is that financial advisors consistently have ranked us, the most read and most shared content. And that's regarding our Monday morning outlook and our data watches. So we put out 1-page, roundups of the data and, kind of our outlook on what things that are going on. So, I really would recommend, if you're not signed up for the Monday morning outlook, that's a great resource. It's, shareable with clients. We make sure everything is, easy and fast to read, because we respect that you guys are getting tons of emails. It's hard to prioritize. So with all that, I think let's take it to the next slide here. So that one should read the coronavirus contraction. So, it's actually crazy to think that just a month ago, we were at all-time highs. The labor market was the strongest it was in 50 years. The horizon looked, pretty much clear, and everybody was optimistic. Things looked good. And then all of a sudden, this virus popped up over in Wuhan, China. And initially, the Chinese government, as they are wont to do, were suppressing information. The initial doctor that had, come out and, blown the whistle kind of about this new virus that was running rampant, was made to sign a public apology about fear-mongering. He later actually died in the hospital system in China. And, to this day, now people are kind of looking back and wondering how accurate the data we actually got out of China was. And it does seem like if they had been more transparent, possibly the world could have been better prepared. But now here we are, and I think Eric mentioned that these are unprecedented times, and going forward, as I take you guys through my presentation, I think unprecedented is just a great word to describe it, because some of the things that we've been seeing over the past 3 weeks, month, we've never seen before. So in some ways we are in uncharted territory. I think the way I'm going to kind of frame this presentation is, I want to start off with some of the bad news, some of the things that are certainly scaring people. And you can see that in the equity markets with volatility, obviously crazy, going all over the place. But you could even see it in the bond markets, in gold, even Bitcoin. Some of these historically very safe haven assets that, the flight to safety would, in a textbook would tell you that, hey, these are the things that are going to outperform during a crisis. But it seems people have been kind of selling everything, raising cash to get through this uncertainty. So, it's going to be an interesting couple of months going forward. We still believe that, hey, listen, the United States, if any country can get through this, it's going to be the United States. We do have some great assets on our side, and I'll definitely get into that as well. So let's go ahead and move on to the next slide there. So we have just lived through the fastest bear market in U.S. history. So this chalk one more up to the unprecedented ledger. So S&P 500, the number of days from the peak to a 30% decline. So as you can see, there are a couple of days in the 1930s when we were dealing with the Great Depression, where we saw a similar length of time for bear markets to take hold. And yeah, it is actually kind of funny that, the Dow has now rebounded back into what would technically be called, I guess, a bull market again. Obviously, over the next couple of months, I don't think volatility is going anywhere. I don't think that we've started on, the permanent upward slope. I think there'll still be, a lot of volatility, a lot of ups and downs, but I do think that, the picture for the American economy and the equity markets is improving, but there are still a ton of unknowns out there. And in economics, what we call something like coronavirus is an exogenous shock. So, it's actually funny. I was thinking back to undergraduate economics classes, how, if any of you guys took Econ 101, in the textbook, they always talk about an exogenous shock to the economy, and it's always a pandemic that they talk about. So it's kind of ironic that, the economics profession, we drill it into all the students' heads that, hey, this is an exogenous shock to the economy that's possible. But, a pandemic is one of those things that you just really can't see coming. So now, going forward, it's really about how we respond to this thing. That's going to determine whether or not we're able to, bounce back very quickly, have a V-shaped recovery, or if we're going to see something that's a little bit more protracted and dragged out. So if we can move on to the next slide there. So this one I titled, "We're Likely Already in Recession." So what you've got here is U.S. real GDP, the quarterly percent change at an annualized rate, going all the way back to 1947. So if you look over on the far right side there, we've got two that are in orange. And these are kind of our projections for Q1 and Q2. So, Q1, and this is kind of one of those things where every week our forecast has been getting revised, because we've just seen, consistent, I wake up, every other day, and it seems like a new city or a new state has gone on lockdown. And, initially we were thinking that we were going to skate by in Q1 with, minor growth. But, now that we've seen California shut down, New York is shut down, we're seeing a lot of these shelter in place orders. It's clear that, it's not just going to be fewer people going to, restaurants and bars that are the issue anymore. Now we're seeing kind of a short-term collapse in consumer spending, especially in, kind of the retail, bars and restaurants, and kind of leisure and hospitality categories. So with Q1 likely to be negative 1.5%, that big drop, you see the big orange downward line there, that's our estimate for Q2, and that's going to be negative 20% at an annualized rate. So if you look back in history at all the other lines that are below zero on that chart, you'll see that that will represent the largest quarterly decline in U.S. history since World War II, which is really, that's when GDP as a statistic was created. So it's as far back as we go. We're not able to kind of directly compare a lot of this stuff to the Great Depression on an apples to apples basis. But kind of the closest we ever got, ironically, to what we're looking at in Q2 was back in 1958. So you can see that's the second largest decline, and that was actually during the Asian flu pandemic that hit us in 1958. So that was a negative 10% annualized hit. But at the time, we'd never seen the kind of shutdowns that we're seeing in the U.S. That we're seeing today. That's kind of a completely new phenomenon. The government has never kind of come in and just shut down broad swaths of the economy by fiat before. So that's kind of what's sent everybody reeling, sent people scrambling to kind of model it out, try to figure out what we're facing. And really, what we're worried about now is the nature of this crisis is kind of a cash flow issue. So, economic time for a lot of people has stopped. People aren't able to go to work. They're not able to, earn the money that they typically use to pay down financial commitments like car payments, rent, mortgages, things like that. So while the economic time has stopped, the financial time still keeps ticking. And that's really created kind of a cash flow mismatch, if you will. And that's really the big worry now is that, if all of a sudden all the renters stop paying their rent, that means the owner of the building who has, the commercial mortgage isn't able to pay his mortgage, and that it all flows uphill in the United States financial system. We're all connected to each other. And that's really what I think you're seeing with this widely reported on government stimulus. This is what they're kind of trying to focus on, is sending people cash, making loans available to large companies, and loans / you can kind of call them grants as well to small businesses, so that they're able to still meet those short-term financial commitments, and we don't see this thing kind of stumble out of control and trigger a kind of financial crisis situation like we saw in 2008. So, you can think back 2008, really the big issue was mortgage-backed securities, right? We lent out too many mortgages to too many subprime borrowers, and when some of those people weren't able to meet their commitments, it's hitting those mortgage-backed security values, and that caused widespread pandemonium in the financial markets. Well, if all of a sudden people aren't able to pay their rent or their mortgages, things like that, you're potentially looking at a similar situation, though we're not as over-levered as we were at the time. The banks seem a lot healthier. So I wouldn't say it's the same degree as 2008, but you can kind of understand the nature of the crisis through kind of that cash flow lens. So if we could take it to the next slide. Okay, so this one, I titled it "Big Companies Should Be Able to Weather the Storm." Obviously, there's going to be some large companies that are going to get affected worse than others. The airlines are a great example of, their revenue has just dropped to absolute zero. But if you look in aggregate, this is non-financial corporate interest payments as a percent of cash. Before this crisis kind of manifested itself, the big worry was corporate debt being, companies being over-levered, the level of debt to assets, things like all these kind of historical valuations of corporate debt being very elevated. But I think it's important to note that, interest rates being so low, interest payments as a percent of cash on hand for a lot of these companies is historically pretty low, kind of back to where we saw in the 1960s, 1970s. And, we've all heard the stories of stock buybacks, things like that. And a big reason why stock buybacks have been so popular is that companies have just been sitting on such a large pile of cash that they don't really know what to do with it. So, the good news is if you look at the aggregate, kind of the big corporate sector, they do have a lot of cash that's going to help them a lot to kind of weather this storm. If you look at it against kind of their interest payments or their interest obligations. You could probably throw in, mortgages and leases for buildings and things as well. But I think this kind of does a good job of showing where the bigger companies kind of are. And now with, they have access to capital markets that the Federal Reserve has been, very active inside of. So they should be able to get access to funding, some of the more egregious situations like the high yield energy market with oil falling so much recently withstanding. A lot of these companies should be able to tap, credit and use their cash on hand to kind of make it through the next quarter or so and stay solvent, retain a lot of their employees, things like that. So, I don't think that you're going to see as big of a wave of kind of large corporate bankruptcies you saw in 2008. But that's not to say that, there isn't a big worry with business in general. So if we could take it to the next slide. So this situation is going to be a historic challenge for small business. Going back doing research over the past week or so, I really don't know how a lot of these small businesses are gonna weather this storm over the next month or so. So, if you look at these are kind of some of the best studies I could find as far as visualizing the data, kind of making it very clear where small businesses stand. So if you look at the left side of that slide, how long can small businesses survive if sales stop completely? So about I'd say like 55% of small businesses can't make it 3 months with zero sales. They just don't have the cash on hand. And if you look at the other graph here, the median cash buffer that these small businesses have is only 27 days. So, the restaurant sector, I think, has been talked about the most. They're actually the lowest on that, only 16 days of cash. And if you look at what we're talking about here, it's, how long could just their cash balances sustain them if all inflows stop? So kind of a similar situation to the other chart there. But, that varies throughout kind of the different classifications of small businesses. But, with the high end being 47 days, we're talking about like kind of a month and a half situation that in the best case, a lot of these small businesses can survive when their revenues drop to zero. And that's really what we're seeing with these shutdowns. I live here in Austin, Texas, and, just seeing the main strips of businesses, small retail, restaurants, bars and things like that shut down, it's hard to see how a lot of these places are going to be able to weather this storm effectively. So there are provisions in the stimulus or the kind of the economic rescue package that's being put through the Congress and Senate that pertains directly to small businesses through the Small Business Association or Administration. They've got about $350 billion earmarked for small businesses. However, the only issue with that is how long is it going to take for these small businesses to actually get that money? Right now, Congress is talking about how it's going to take 2 to 3 weeks just to get the checks out the door to people that already have direct deposit set up with the IRS. The $1,200 checks that we've been hearing about. Small businesses going in, applying for loans through the Small Business Administration. Some people are talking about, maybe they would apply with their local banks, and then the Small Business Administration would then buy up those loans from across the country and kind of securitize them and then sell them to the Federal Reserve. That's also a possibility. But it's important to note that, we don't have this infrastructure set up at all. we're already about a month into this situation, about 2 weeks if you're talking about these shelter-in-place orders that have really closed a lot of these businesses. So I'd say we're already, pushing on the edge of what a lot of these small businesses can handle across the country. Restaurants especially seem to have already kind of been hit really hard. So there's been kind of some mitigating factors. Here in Texas, they're allowing them to do, delivery of alcohol, for example. I got a pitcher of margarita delivered to my house last week, and that was pretty cool. But, again, the amount of income that they're having versus what they used to have and their fixed costs, it just seems like, I am fearful that a lot of these smaller companies that I patronize are just not going to be around once this thing blows past. And that's really the big worry right now is, trying to find a way to keep as few businesses from going into bankruptcy as possible and keeping as few people from falling into the unemployment rolls as possible. Because, once businesses disappear, it's not like, we lift the shelter-in-place orders and these things just come back all at once, like flicking on a light switch, right? It's going to require, finding employees all over again, applying for loans, getting approved, finding a new lease, all these things that are, if we do see bankruptcies soar and we do see unemployment, spiking, then it's going to mean that the recovery is getting dragged out more and more. It's making the V a little less V-shaped. So, going forward, it's going to be really crucial that they're able to get these small business loans out because, small businesses do employ, I believe, about 45% of the U.S. public. So, if they're the ones that are kind of feeling the hurt, that's a significant portion of people whose, livelihoods are at risk. So if you can go to the next slide for me. So if anybody has been watching CNBC or Fox Business at all today, or if you've been on Twitter, I'm sure that you've already seen this exact chart. But I do think that, this is, kind of a bad omen for what's to come over the next few weeks. So this is new claims for unemployment insurance. So we all pay our FICA taxes every 2 weeks. And that means if you're laid off, you're able to apply for unemployment insurance. Economists love this measure because, this is a weekly measure. It's very timely. So this is for last week. And this is new claims for unemployment all the way back to 1967. It's as far back as the data goes. And if you look all the way on the right side, today we had about 3.4 million people file for unemployment insurance. And that is by far the highest amount of claims that we've ever seen in the historical data. I think the previous high was sometime in the 80s, and it peaked around 650,000. So we're an order of magnitude higher than that. And I think over the next couple of weeks, like we were talking with small businesses, it's not like that you can just say, hey, listen, we need to ride it out another month, another 2 months. A lot of these businesses just don't have the cash. They didn't have the margin to begin with to deal with a lot of this stuff. And I think you're going to consistently see some big spikes in unemployment from those people being laid off, especially, at small businesses. So while the bigger companies might do some trimming of headcount, most of this is going to be coming from the smaller companies. So, like I was saying, the higher unemployment spikes, the longer the recovery is going to kind of get dragged out as we need to kind of reorder all those factors of production, the labor and the capital and the buildings that all these small businesses had put together. This is one of those numbers that definitely has us worried looking at this. It's important to note that, yes, this pandemic definitely needs to be dealt with. I think that, a lot of the lockdowns, especially in urban areas, are important, but, it's important to take note of what's happening to a lot of people as well. And we need to find a way to kind of ease the transition for a lot of the people affected by these shutdowns because, obviously these businesses didn't do anything incorrectly. They kind of got caught up in the gears of history a little bit here with some of these necessary public health measures. So I know I just walked you guys through a bunch of kind of depressing data points there. So let's turn over to some of the more positive stuff. So if we go to the next slide there. So this is the number of daily U.S. coronavirus tests that have been conducted. So if you look back at the beginning of March, we were doing about 200, 300 a day. And over the course of the month, now we're up to about 75,000 a day. So this is one of the most heartening points of data to me, is that after the initial kind of rollout, which was terrible, the CDC not only did they drop the ball on kind of warning the entire country about how bad this thing was going to be, they also severely hampered testing capacity at the beginning. All testing of coronavirus had to go through the centralized CDC and their laboratory. And obviously, when you're talking about testing tens of thousands of people a day, we actually need to be testing, I'd say, 150,000 people a day. So we got to about double from where we're at today. And I think, we'll probably be there by next week. So that's good news. But, we're talking about testing that many people. The CDC itself just does not have the lab space, the staff, any of that to accomplish these things. So, what we've seen is just a big rollback in regulations. So the FDA has been forced to approve private laboratories to help conduct these tests. They've been approving through emergency use, is I believe the legal term that they're using, a lot of new kind of tests that are much faster. But I will say that, the FDA just seems like it can't get out of the rest of the country's way. A lot of you probably know that there's a big shortage of personal protective equipment like masks and gowns, gloves, things like that. And a big part of that is, the FDA, because those things are considered medical devices, the FDA needs to inspect essentially every shipment of these things. So, here in Texas, in Houston, we had, 30 million masks, things like that. 3 million masks, I think 30 million altogether pieces of personal protective equipment, something like that, sitting in a warehouse waiting for, an FDA inspection. And now really they've started cracking down on at-home coronavirus tests. So there's some companies that have popped up that have offered, hey, just like a drug test or, whatever else you need to test for, they ship a kit to your house, you swab yourself, you ship it off to them, and then you get a result. The FDA is saying, hey, listen, these might not be accurate enough. They might give, false positives. But, from my perspective, what's really important is getting as many people tested as possible so we can understand the outbreak that we're dealing with. So, if a couple, if 1 out of 100 people or 2 out of 100 people get a false positive on their coronavirus test and end up staying home anyway, I think that's really kind of not a big deal in the grand scheme of things. I think it's important to find everybody who, is positive and get them into quarantine so we can, begin taking the steps to get the country back up and running again. Because, in a debt-driven, kind of credit-driven financial system, like I was talking about, where financial time keeps moving, you can stopgap, or bridge loan yourself for a short period of time. But, it's important to note that, the political sausage, when it's made, is not made perfectly. So there's going to be a lot of people that fall through the cracks, even if they do pass legislation in a timely manner. And, if we're, still doing this in several months, which I don't think will be the case, but if we're still in the place that we're at in several months, we need to, watch Congress go back to the drawing board and pass more relief measures. That's going to definitely get dragged out as well. So, really the number one priority is just testing as many people as possible, getting those that are infected into quarantine, so we can begin, the recovery process. So some great news on the testing. We've really ramped up a lot, which is a good thing to see. So if we go to the next one here. I'm sure you've all heard the term at this point, bend the curve or bending the curve. And this is really what we're talking about. So we're talking about new daily U.S. infections. So the number of people every day that kind of, new infected people that pop up. So when we talk about bending the curve, what that means is, hey, the peak amount of people testing for coronavirus, we've hit that and we've started to come down the other side. That means we've begun to identify the majority of the people that have it. And in the United States, we've continued to see growing numbers of new infections on a regular basis, which is unfortunate. But I think it's important to note that a lot of these models that we're seeing floating around, where the United States, 60% of the people are going to become infected, and then they draw a death rate from that. Or I think Gavin Newsom in California, the governor, was saying a similar thing. He expects 60% of Californians to become affected or infected. This relies on models that are based on continuous exponential growth, right? So they don't take into account the mitigating measures that our country has been taking. So the lockdowns, the shutdowns, things like that, social distancing, all the other, kind of new buzzwords surrounding the coronavirus. So it's also important to note that due to the shortage of U.S. tests, we've really been kind of triaging who's able to get tests in the United States. So, I'm sure if any of you have been online or you've read kind of anecdotal stories, there's a lot of people talking about how they aren't able to get a coronavirus test. And the reason for that is that, the limited supply in the past had been kind of triaged or saved for the highest risk people. So the people that we've been testing over the past 3 weeks have kind of been the most obvious carriers or the people that have become the sickest. So I think going forward, my guess would be that we kind of start seeing a bend in the curve in mid-April. So, 2-3 weeks from now, as testing, really ramps up, we, see 150,000 or more tests a day. We should be able to find everybody relatively quickly and see, that curve start getting bent. And at that point, we can really talk about, getting people back to work, allowing a lot of these small businesses to reopen. So that's good news. So last thing here, if we go to the last slide. So I think that this is some really important context. So this is U.S. confirmed coronavirus infections by state. So, most of the time when we look at these numbers regarding the coronavirus, we talk about how many infected people do we have in the United States, like that prior slide was showing. But, it's important to note that, the United States is, I believe, either the second or third largest country on earth. And these cases are not evenly distributed across the country. So if you look where the coronavirus cases are, about 50% of them are just in New York alone. And it's not, the entire state of New York, obviously. It's, mostly in Manhattan or, Brooklyn or, the boroughs of New York City itself, which, urban areas are the places that are the most susceptible to infections. We know that, right? People are living on top of each other. They're in close proximity. So those are the areas that are most affected. And you look at the other states that have been hit the hardest. You're talking about New Jersey, which is right by New York. You're talking about Washington, which is mostly Seattle. California, Illinois, that's Chicago, San Francisco, LA. And recently we've seen a spike in Louisiana as well with New Orleans. But the vast majority of these cases in the United States are in, 4 or 5 major urban areas. So, that means that, if we can contain them to those cities, we should see, kind of a peak in new cases relatively soon. So the positive view would be that, hey, most of this is in New York. It's in kind of some other urban areas, but it doesn't spread to the surrounding areas or the more rural states. And kind of the more negative view would be that, hey, what we're seeing in New York now, we're going to see in Texas and Indiana and Arizona. and across the country. Right now, we don't think that's the case. We're about 2 weeks into the shelter-in-place order, so which a lot of us are living with, which means, a lot less people are traveling to different states, having personal interactions with other people. So the growth rate, the exponential growth rate that we've seen so far, we do believe should begin to start tapering off. But, I do think this is important to keep in mind, this context, when we're hearing people talking about, hey, just shut the entire U.S. economy down, or, why doesn't Donald Trump just do a federal shelter-in-place order for 2 weeks, or, things like this. But, there's a fallacy of composition inherent in those claims. What we need to do is we need to find the infected people, we need to quarantine them, and most of that is happening in urban areas. And I think, kind of a one-size-fits-all solution where what we do in New York, we also do to, Wyoming, is going to have more negative effects than it is positive. So I think going forward, there does need to be a balance between public health measures and, the effects it's having on the economy, because there are real effects, specifically with, small businesses and unemployment kind of soaring. So, as we see New York kind of handle their situation, and, another positive thing to kind of point out here is, if you guys remember, the major first hotspot that we saw with coronavirus was actually in Seattle, Washington. So if you look, Seattle is one of the top three. That's true, but it does seem like Washington, Seattle itself has been able to kind of contain the situation, and we haven't seen a big spike like we're seeing in New York, which is also kind of an international travel hub. And if you would ask me, 6 months ago, hey, Bryce, there's going to be a global pandemic. What city in the United States is going to get hit the worst? I think pretty much everybody would have guessed New York City, just because it's, such a melting pot, has so many people from so many different countries flying in and out every day. So, going forward, I don't think the right thing to do is a nationwide shelter-in-place order. I think that we were on the right track initially where, hey, listen, we need to cancel South by Southwest or other concerts and big public gatherings, because those are clearly a big risk. I think, bars, to some degree restaurants as well, it makes sense, especially if you're in like a really busy, brewery or bar where you're around a lot of people. But, these shelter-in-place orders, I think that we've kind of gotten to the point of diminishing marginal returns. So, for me here in Texas, a good example is, they just shut down the doggy daycare center down the street from me. So, doggy daycare, dogs cannot get coronavirus. There's probably 2 employees in there at any given time. If they were to wear masks, make sure that they stayed an arm's length or 2 from customers, I don't think that there's any reason to really shut down those kind of small businesses that are, really operating on thin margins. But, now we're talking about however many people work at that doggy daycare center, now because it's a non-essential business, which is kind of an arbitrary designation in the first place. Those people are now going to be either on unemployment or, they're going to be having trouble paying their mortgage and rent and things like that. So it's important to keep in mind, where these cases are, and kind of, keep an eye on this situation. But I think kind of a nationwide kind of one size fits all is not what the United States will benefit from the most. So with that, I guess I'll throw it back to Eric or whoever, and we could do questions or whatever you guys want to do.
Yeah, thanks, Bryce. Really appreciate that fine presentation. And again, to everyone that's on the line, we will archive this and be able to distribute this out later. But I think Jeff has fielded a couple of questions on the Q&A panel. So I'll let Jeff bring those up, and I've got a few down here. So Jeff, why don't you go ahead?
Well, yes, thanks a lot, Eric. So I have, Bryce, I have a question from Ed Trebas. He said, I also heard there's only $350 billion for business loans. Does that seem enough?
Yeah, so I think right off the bat that there's no way it's going to be enough. I've seen estimates that just small business kind of in a bailout sense or, or replacing their cash flow sense, it needs to look more like around $1 trillion. So I definitely think we're going to see kind of Congress have to get back together in a month or so and kind of pass more small business, loan, either guarantees or grants or something, because, A, it's already taking too long to get this money out the door to these smaller businesses, and B, that number just doesn't seem big enough to me when we're talking about shutting down entire sectors of the U.S. economy.
Absolutely.
Yeah. Hey, Bryce. So a question that I've got is, kind of once we get this, this hypothetical all clear, I mean, talk about the challenges in getting the economy back up and running and, reconstructing, reconstituting supply chains, and just getting the economy back and moving. I mean, how do you see that when you guys deliberate? How do you see that playing out, and how long is that going to take?
Yeah, so, initially, I thought the bounce back would be really quick. But the more I look into kind of the things that these small businesses are facing, my worry is that we probably won't be back to where we were for maybe a year, maybe a little bit over that. And, granted, that's still much faster than the Great Recession in 2009, right? So that was an extremely slow recovery. So I don't think it'll be that bad. But, again, the longer the shutdowns continue, the higher unemployment and bankruptcies go, kind of the longer it's going to get dragged out. And just, what we're seeing with these small business loans, how long it's going to take, it just, and the general kind of consensus on just shutting down the whole country for an extended period of time, it does look like, the recovery isn't going to be as swift as it could possibly be. And, a couple other things I would note regarding the recovery is, A, I think you're going to see businesses after kind of getting caught with their pants down during this whole thing, start building up cash reserves like we haven't seen, especially small businesses in the past, which, it's good to have a rainy day fund, but at the same time, it's very inefficient to just sit on cash when you could be using it to expand or hire. So that's definitely something to take into account. And then lastly, I would say, if you thought what we'd seen with the China trade war was bad before, I think that there's just no way politically that there isn't, some kind of backlash against China for this situation. And I don't think it's just going to be the United States. This is a worldwide situation. But, I think you're going to see a lot more talk of reshoring manufacturing in the U.S., especially regarding things like personal protective equipment and medication. I think a lot of other manufacturing is going to come as well. They were already looking to do that and diversify their supply lines. But now after this, I think that, you're going to see an influx of investment in the United States, which, is good for the country. But, supply chains are going to have to reorient, and that's something that takes time as well.
Yeah. Hey, Bryce, do you feel like wading into the whole forest law? I know Brian's talked about it quite a bit. And do you feel like getting into that at all?
Yeah. So FAR's law is basically kind of the premise that every pandemic we've seen in history is kind of a bell-shaped curve. So, initially we have exponential growth, and then human beings, we take, protective measures or, measures to kind of curb the growth like we're seeing with, social distancing and everything else. And it turns into a bell shape and comes back down the other way. So, when I was talking about kind of the exponential growth rate models that we're seeing out of places like the Imperial College in London, or, places, where California is talking about 60% of our population is going to be infected, that just kind of flies completely in the face of every other pandemic we've seen. It flies in the face of, FAR's law. And, it's important to note that, it's true that coronavirus, this is probably one of the most infectious diseases that we've ever seen. And my understanding is that, it kind of hits that sweet spot where it sits latent in people before showing symptoms. So people that are asymptomatic are walking around, things like that. And that's part of the reason why you need, social distancing and stuff like that. But, I don't think that we're going to see this break FAR's law. I think that, that's something that is a law that will hold. And, it's important. I was looking back kind of on the FAR's law thing, and one of the things that popped up was, I don't know if you guys used to watch Oprah back in the 1990s and late 1980s, if anybody's old enough to do that, to have done that. But, if you remember the HIV and AIDS epidemic kind of at its height, they were having people on the Oprah Winfrey show talking about how, everyone in the country was going to get this. Even if you're a monogamous, married couple, everyone's getting HIV or AIDS. And that was kind of the same fallacy, right? Just pure exponential growth with no mitigating factors. It didn't happen then. I think that we're not going to see it happen now. And, we're going to beat this. It's just going to take, everybody working together and, trying to find the sweet spot between, lives saved and mitigating the economic damage.
Yeah, and I brought that up to kind of hopefully end on a positive note, because if you apply, again, we're building a data plant here for U.S. cases, as you showed in that slide, and so we're getting more data every day. But if you overlay, the data that we already have from China, and some of the Asian countries, I mean, we can kind of measure the crest in terms of weeks rather than months potentially. I think just looking at the historical bell curves, I guess, if you will. So, would you concur?
Yeah, I would concur with that. And yeah, if you lay it over other countries, China especially, I think they kind of handled their outbreak in about a month's time, something like that. Now, granted, China is able to use methods that in the United States we're not comfortable with. And, even if that is the best way to solve these situations, I think that most people still would not be, willing to go through kind of what the Chinese put, the people of Wuhan through. So, granted, they did have more stringent containment measures, but I do think that, I agree with what you're saying. I think that we're going to see kind of a peak in daily cases in the next 2 or 3 weeks. We're already about 2 weeks into this whole social distancing and shelter in place stuff. I think that should give us, it should stop the spread, and it should help us, identify who's got it, and we should start seeing a slowdown and decline in new cases.
Hey, Bryce, I've got a couple of questions from the other folks. Do you see any markets or industries that are going to take huge hits and struggle to recover?
Yeah, I think consumer discretionary spending is going to take a long time to get back to where it was, kind of just luxury spending that we've seen before. I'd say the travel industry is, 9/11 is a good reference point. I mean, that hurt the travel industry for years and years. And this is far worse than 9/11 was, and it's, more concentrated in travel. I just don't see people taking, as many beach vacations or flights to, Asia or Europe as they had in the past. I think this kind of pandemic and public health stuff is really going to stick in people's brains.
Excellent. Another question from Tom Kemmler on our team. The Imperial College in London, who is the most pessimistic source for many government restraint actions, just backtracked in a huge way today. It had estimated 2 million U.S. deaths. It cut its estimate for the UK from 500,000 to 20,000. Since many politicians had relied on this as a source for their concerns, do you think this is a major estimate change, might bring some relief from the lockdowns?
Yeah, I mean, I did see that retraction, and I guess that just kind of shows, there's some bad incentives involved in things like epidemiological modeling. I don't want to impugn motives or anything like that, but if you do want to get your study shared widely and recognized, you want to go big with it, right? And like I said, these exponential models are based on, human beings have absolutely no response to a pandemic. We just kind of go about our daily lives. Nothing changes. We don't wear masks. So, once they put some more realistic assumptions in those models, all of a sudden it's not so worrisome anymore. And that's kind of where we've been with this from the beginning. Though I will say, I don't think anybody in the U.S. really saw how bad this was going to be. But I do think, you have to have some realistic assumptions in your model. So, anytime you see kind of headline grabbing estimates, it's important to, take the time to dig up what the original study is and see what those assumptions are, because, assumptions can be the big factor with a lot of this stuff.
Great.
Thank you, Bryce. It looks like that was the last of our questions from the audience. Eric, did you have any other questions?
Yeah, no, I was going to thank Bryce for his time. I think, Bryce, we have talked about getting a client, event together. And obviously that we had something actually that was kind of tentatively scheduled for next month. That's not going to happen. We would like to have another event, perhaps in the summer, where we kind of do a check back on all the data, that's transpired between now and then and whatnot. So we'll be in touch with all of you as those types of things develop. Obviously, we got to get through kind of the here and the now and what we can see, 2 feet in front of our face. But, I hope that this was really helpful to all of you. And again, having a trusted third-party entity that we trust greatly and collaborate with, provide some valued feedback that kind of dovetails on some of the things that we've been talking about in some of our videos. I think it's clear that as we go through this, episode of COVID-19, that we're going to continue to drive more communications to you, drive more, of the things that we're seeing and we're hearing and we're studying. And again, we're going to continue to leverage First Trust for, all of the great work that they do, and appreciate their collaboration very, very much. Bryce, thank you very much for your time. And everyone else, I appreciate you spending the time with us. I know we're a few minutes past the hour, but we did get started a few minutes late. So we will hopefully do one of these again fairly soon. And again, please send us your questions and your comments, and we'll be back with you accordingly. Jeff?
All right. Thanks very much, guys. It was nice talking to everybody. Everybody, stay safe out there.
Thanks, guys.
Thanks, y'all.